presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for September 26th, 2023. I'm Mo Ansari, President of Compak Asset Management, and host of Market Wrap. You can get all the daily edition of Market Wrap simply by going to compak.com/media, and you can get the daily edition. You can get Mo's Market Minute. You can get this YouTube update. Obviously, all of the information is there. I'm going to talk a little bit about the Fed, especially interest rates, what has happened to rates and what it is doing to the market. Then we'll do some technical analysis and the week ahead. Let's start with the Fed. The Fed meeting last week said this was the original, the one line up top in blue, was where they thought rates would be. They would be coming down at this rate, at this pace, and at this pace initially, the goal line. Now the Fed has raised it and said they're going to keep rates higher for longer, instead of by about 50 basis points, and they don't expect rates to start coming down until the end of next year, and only coming down twice instead of 4 times next year. So what they're saying is rates are going to be higher for longer. That's the report from the Fed. That caused the rates to jump up above the 4.33, and I'll talk about that on the 10-year. Again, the expectation for rate cuts coming down is not until the second half of next year, and only 25 basis points, or 25, and it'll stay there for longer. Looking at the market, again, Treasury yields broke out to the upside, and that is creating some pressure on the market in the short term. I'm going to do a live seminar in Scottsdale on the 18th. If you want to come and attend, go to compak.com/seminars and sign up for there. Or if you want to come to a live webinar, which I'll do in November. But this is probably going to be my last seminar that I'm going to do for the year in Scottsdale. So if you want to attend, make sure you get a reservation early, because it's very limited, the seating there. Looking at the technicals, market has turned down sharply, broke through this, I expected from here. This is the A, B, C, and I thought we'd come down, break this 43.35 area, which we have now, and now we've also, I thought about 43.80 to 4,300, 42.80 to 4,300 would be the number, but today we closed at 42.73, so the next support comes in at the 200-day moving average, which is 41.95. I would say around 4,200. So we should mark a bottom here in this market. We are also in the last week of September. First week of October is usually where we make the seasonal bottom. Everybody is now saying, oh my God, we are going into the interest rates are going to stay up for longer. This will kill the economy. I think, again, the Fed is making the same mistake it did in 2021 when it came out and said, oh, there's no inflation, don't worry about it. 2022, oh my God, inflation has taken off. They had to raise interest rates at the fastest pace in 40 years. Now they're saying inflation is too high. It's going to remain too high. As I've said, inflation is going to continue to come down, and as the economy slows, it is going to even put further downward pressure on inflation. By the time unemployment goes up, usually it's the last thing that happens in the economy. The last thing that people want to do is lay off people. Small companies, big companies, they don't like to lay off people, but that's the last thing. By the time the unemployment rate goes up, we're already slowing down dramatically in the economy. The Fed realizes that and says, oh, we've gone too far, we're sorry. But again, they'll be too late, and they've done too much. That is my interpretation of what we're going to see. The Fed is going to relent, saying the hawkish statements that they made, but it might take them a few months before we do see that sharp slowdown and the economy slowing down. In the meantime, the market will be under pressure, and that's what the market is doing right now. On the weeklies, 4,200 is the number. That's right now this long-term line. And if we break below that, that could really put some pressure. In the short term, 4,400 is going to be resistance, which is the 20-week moving average. Nasdaq also broke below last month's low, and again heading towards, but it is 12.5 is the number, that's the 200-day moving average, compared to 13,000 to 63 is where we are. So we could go down in the Nasdaq a little bit more than where we are, about 400 or 500 points. And even if the S&P does go down to the 200-day moving average or around 4,200, they put it down about 8.6% from the high. Still very positive for the year, but that will be enough to shake out all the nervous nillies, all the people that buy the highs and sell the lows. They're always looking at gloom and doom, and that'll, I think, put in finally at the bottom. As I mentioned in July, that here the next 2 months are going to be shaky. August and September, and here we are at the end of September. Usually we don't make a low sometime last week of September, first week of October, and we're getting very close to that. So that's what I'm looking at right now from a technical perspective. Weeklies have turned down in the Nasdaq, which we'll see. My dot plot here was 13,062. Today we closed at 13,063. So we'll see how the weeklies turn out over the next couple of days. 10-year notes, this was the number, 4.33, resistance right here, and we broke out above it right here. That was last October, and we took off from there when we broke out, gapped up here. Now the next resistance is around 4.5. 4.58 is where we closed. Target becomes around 4.9 to 5% right up here. This is right around 5%. Plus or minus for interest rates. And if we get to 5%, that could be a problem for the market. Again, we have gapped up here. If we turn down and come down here, gap lower, that'll make a top in interest rates and probably a top in the markets. But we have to see that. We have not seen that yet. Gold market broke down below the 200-day moving average, probably 1900. But from this projection, the Fibonacci comes in at 1882. Which is quite a bit lower. I think we don't go down that much, but we'll have to wait and see. Somewhere around here, 1875 or so would be a good number. Oil has gone up. We're very close to these highs right here that we made in last year, and now we've come back up, tested that 93.75. Support 87.95, then that's the 20-day moving average, and then 83.33, that's the 50-day moving average. We do get the PCE this week. That's the Personal Consumption Expenditures Index from the Fed. It comes out on Friday. That's the long-term inflation number that the Fed looks at the wholesale level. We'll have to wait and see how that comes out. So the market under pressure, but we're thinking closer to a bottom unless we break 4,200. If we break 4,200, then we'll have to start looking at everything all over again and could be headed quite a bit lower, maybe in a much bigger recession, but we'll have to wait and see. Right now the pressure is to the downside. I would wait for the bottom to come in and start turning up before we start buying into the market. That's the way I'm looking at those markets. This are my opinions. These are my thoughts. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.